Hello, this is Rob Carrig with Carrig Wealth Advisors of Steward Partners. I am going to do a first half of the year update mostly for our clients. Today is July 8th, 2022. What I'm going to do today is share a number of slides courtesy of JP Morgan. The source of this information is all from JP Morgan, unless I tell you that it's from somewhere else. And I'm going to share my screen and start with some important disclosures. Full screen up. Okay, Carrig Wealth Advisors of Steward Partners. Again, I'm Rob Carrig, certified financial planner, wealth manager, managing director at Steward Partners. Information is from JP Morgan Asset Management as of the third quarter of 2022, June 30th, 2022. And at the end, I'm going to show some important disclosures. So what I'm going to do today is go through about 5 or 6 slides, probably take 10 minutes or so. I want to be clear on one thing for our clients is in no way is these video updates any substitute for our one-on-one Zooms and meetings and calls. Christina will be in touch as always to schedule those check-ins, but if you want to talk in between, please get in touch. My email is rob.carrig, C-A-R-R-I-G-G, at stewardpartners.com. And my phone number is 603-427-8840. All right, first slide, again, all of this from JP Morgan. I always show this slide. Many of you have seen it many times, but every quarter it looks a little different. So a couple of things I want to point out here is, the stock market from the end of the financial crisis to going into COVID went up 401%. Along the way, there were many 10 to 15 to close to 20% pullbacks along the way. 20% pullback is normally what is considered a bear market, what we are experiencing right now. The beginning of COVID, stock market went down 34% in the span of about 5 weeks and didn't take much longer than that to recover, then went up 114%. And as of the last 6 months or so, we're down about 21% for the S&P 500 total return off of the peak from January 2022. I want to be clear with everybody, it doesn't feel good. It doesn't feel good to me or any of our clients. 20% is a big number. And when we get into how bonds have done, that has hurt as well. So if you're feeling not great about what you've seen the last few months, I get it. Unfortunately, it's kind of the way it goes long-term with the stock market. Every 5 or 6 years, we have one of these 20% pullbacks, and 5 and 10 and 15% pullbacks are actually much more common. One more thing I want to point out before I go to the next slide is you can see here that on January 3rd, the PE ratio, so price to earnings, it's basically just a way to say how expensive or inexpensive is the stock market, was at 21. And the good news is, as of June 30th, 2022, that had come down to 15.9%. I'll show you a slide in a second to show you that's slightly below the average PE ratio. So one piece of data that the good news is stocks are a lot cheaper and maybe a better deal going forward. Okay, that slide's right here. So you can see the 25-year average PE, price to earnings ratio, forward price to earnings ratio. Any of this stuff, if anyone wants more info on, just let me know, is 16.8 and it's now 15.9. Does that mean that we're done with this bear market? Definitely not. That could be the case. You can see in previous bear markets, prices got even cheaper, but on average, we're below the average, which is, good from a valuation standpoint. I know there's a ton on this slide, but I'm just going to focus on a few things here. So year to date, sector by sector. So I'll start, the S&P 500 for the first 6 months of the year was down 20%. Again, source of all this information is right here. Sector by sector was pretty interesting. Sometimes the stock market, every sector goes up together and every sector goes down together. That was not the case this year, so far this year. Again, market down 20, energy stocks up almost 32%. Utility stocks down, but down just 0.6. What's really hurt here is consumer discretionary down 32.8, tech down close to 27, communication services down 30, real estate stocks, maybe not your home, maybe not private real estate, private non-traded REITs, but down 20%. So tough start to the year, even tougher for our clients who invest with an ESG lens, environment, social, and government screens. Mostly because those portfolios tend to have zero energy exposure. So you're missing out, you missed out on this part of the portfolio, and zero utility exposure. And then as a result, own more of all of this here. So I bring all this up just to say, if you feel like your portfolio is struggling even more than the market, and you're an ESG investor, that's probably the reason why. I'm going to skip this one. You'll thank me for that. This one's not fun. All right, so this one here, I'm going to talk about interest rates. So the beginning of the 80s, 1981, if you bought a 10-year US Treasury, you gave your money to the US government and said, I don't need it back for 10 years, they would pay you 15.8%. That number last summer, like the initial summer of COVID, was somewhere in the neighborhood of 0.5. 10 years you give your money to the US government, in exchange they give you 0.5. That shot up to the June 30th, almost 3%, and has been above 3%. Now, many of you probably are thinking and said to me, yeah, but that's still super, super low historically. That's true. The point is, the markets in general care about change. They care about things getting better and worse. And the change from 0.5 to 3 is about as rapidly as interest rates have ever gone up. And as a result, bonds and bond funds went down about as quickly as they have ever done before as well. So I'll show you that slide here. So year to date 2022, a bond index, US aggregate, Bloomberg index was down 10.35%. Sources are all right here. So that's about as bad a bond market as we've ever seen, certainly in my career, but some would argue you have to go back over a century to see a bond market as bad as that in 6 months. If you bought a 30-year US Treasury bond at the beginning of this year, and you looked at it at June 30th, it was down 23.57%. Now, yes, if you hold it for the remaining 29.5 years, do you get back your money plus principal as long as the US government doesn't default? Yes, but that's a long time. And it's going to look pretty ugly on your statement for a long time as well. So basically what we had was a really tough 6 months for the stock market and a really tough 6 months for the bond market. This chart also pretty busy, but I'm going to focus on some details here. Any given year, let's just take a random year, 2026. What the folks at JP Morgan are doing here is saying what sector did the best that year. So small cap stocks were up 21%, and what did worse? Cash of 0.3. And the gray in the middle is supposed to say if you have a diversified portfolio that's a little bit of everything, you're never at the top, but you're also never at the bottom. So even 2008, the great financial crisis, down 25%, a diversified portfolio. The next year, up 25%. Somewhere in the middle ever since then. And we're showing year to date, first 6 months down 14.6. Now, this is just sort of a random estimation of a diversified portfolio. So, some clients might own something like this, but just as kind of a benchmark, down 14.6. Who knows what the next 6 months or year, a couple of years will hold. But historically, we've bounced back pretty well when a diversified portfolio goes down. And my last slide here, I've shown this one before, I'll probably show it again. The average investor from 2002 to 2021, again, source of information is all down here. The average investor did 3.6%. Inflation, 2.2, seems staggering based on what we're looking at right now. And cash, money in the bank, did about 1%. The S&P 500 over that time period was up 9.5% per year, compounded. Why do individual investors do so much worse than the S&P 500 and do barely better than just keeping your money in the bank? I am firmly in the camp that that is because people buy when things are high and they sell when they're low. I see it, unfortunately, a little bit with some of my clients. People are very excited about getting money into the stock market when things are going great, and they do not even want to talk about the stock market when things are low. They get back in when things are high. One of the reasons why institutions and endowments tend to do much better than individual investors, in my opinion, is that institutions don't do that. They stick it out and probably are looking to buy when things are low, like right now. So important disclosures are here. Again, my name is Rob Carrig with Stewart Partners, Carrig Wealth Advisors, and I can be reached at 603-427-8840. If any of this is helpful, please let us know. And if you'd like to schedule a one-on-one Zoom or meeting or call, please get in touch. Thank you.